Good afternoon, everyone. I'm Pamela Hastings, Relationship Manager here at Barometer Capital, and we welcome you so warmly to another Barometer Readings webcast with our Chief Investment Officer, David Burrows. On today's webcast, we will be pleased to provide a brief macro overview, and of course, at the tail end of David's conversation, he would be pleased to address your questions. So don't be shy. You can send those questions under the Q&A or the chat on the Zoom. And on that note, as we march through the middle of February, I turn the conversation over to the one and only David Burrows. Good afternoon, David. I hope you're well.
Hey, Pamela. Everything's great here. We got sunshine coming in the window.
Wonderful.
Market eked out a small win today, so we're in decent shape. Thanks everybody for joining today. It's a good time to have a call. We're through the first month of the year, 11 to go. You know, as they say, as goes January, so goes the year. The average stock was about flat through the first month, but the S&P was positive. And here we are sort of working our way through the first week of February. We're dead in the heart of earnings season. About half of the S&P 500 companies have reported. We'll talk a little bit about that. And we'll take a look at the market internals to take a look at what sort of themes are standing out, what sort of things are changing, and sort of how the portfolios are lined up to deal with kind of the market that we have. So as we've said now for a number of years, we think that we are in a structural bull market in U.S. stocks. This is the Dow back to 1900. You know, we started this structural bull market when we exceeded the highs from 2000 and 2013. And, you know, there have been certainly some hair-raising moments along the way, not to forget the 2020 plunge with COVID or the 2018 temper tantrum when it came to the Fed tightening rates. But here we are when we look at the big picture, having just recently made a new all-time high in the S&P. So we spent a lot of time over the last year saying, look, you know, we will at some point get to the other side of this valley. And when we do, we start looking at the next business cycle. And that's really where we are. When you go back over time, when the market's made a new high, after over 12 months of not making a new high, you know, in a very, very high percent of the cases, like over 90%, you're in a new bull market, a year out, positive, 2 years out, positive, 3 years out, positive, and lots of opportunity to make some hay while the sun is shining. So market's up about 3.8% since the highs of 2021. A long way to get to this point. But certainly, you know, we continue to stay lower bound by that rising 200-week moving average. The S&P over the course of the week's been up. We've had lots of earnings reports, some good, some bad, but in general, pretty good. Market has been working off an overbought condition from the middle of December and not showing any sign of stalling at this point. The equally weighted S&P, after a very sharp rally off the lows at the end of October, got above the two recent highs from the beginning of 2023 and summer of 2023. And we've been hanging there. Again, you can see on the relative strength indicator working off that overbought condition. But again, sticking right here near the highs. So U.S. markets, you know, in decent shape. Certainly there's some areas that are stronger and some areas that are weaker. And we got to tease out where the leadership is. You know, we don't have to be in every sector. We don't have to be in every stock. We got to find 20 to 30 names to build up a portfolio. And we know realistically, a small handful are going to generate a lot of the returns. But that's going to be a moving target. And we have to stay vigilant. We know U.S. stocks have had massive outperformance versus the rest of the world. It has wavered a little over the last number of months as we've seen global stocks start to do a little bit better. The TSX, after chopping sideways through most of last year in a very wide, choppy band, since October had a really nice lift. We got through the old downtrend. We've been making higher lows. And again, we're trading above the 150-day, the 200-day, the 50-day moving average. We're trading above the highs from early January. Market's in decent shape. When we look at the long-term picture, It's just really clear that we exited what was a secular bear market that went on from 2008 through 2021. Right, that's a long time, 13 years. We had a nice sharp rally through 21 into the beginning of 22, and like the US market sort of went through this bear market and are coming out the other side. It looks a lot like what's happened in other global markets, and I know we've been on this over the course of the year, but it is not going to quit. The Nikkei, after going sideways in a range from 1991 through 2022, is clearly in a new bull market. And this is a big global market representing a lot of big global companies that is really underowned and inexpensive relative to the rest of the world. We talked about India. Look at the last 4 months in India. Since the end of October, up 24% over 4 months. This is a blast off into a new bull market. We look at Mexico, trading very close. Really on the month is now at a multi-year high, going back to 2015. Even Europe, this is the Euro Stoxx 50, 2007 through 2023. 1, 2, 3, 4 strong months blasting off out of the range. So this is significant. It's significant because we spend a lot of time talking about breadth. Sometimes it's to do with a sector. We like to see over time more and more stocks within a sector participate. It's healthy. In a market, we like to see more and more stocks participate. That's broadening purchasing of stocks. Well, when more and more global markets are making new highs, that's also significant. That's more and more persistence of buying in the equity asset class. So for a long time, we've talked about the fact that equities are a place we want to be focused. Over the last number of months, we've said, well, we want to be focused in equities, but we want to broaden our focus globally. We know that the multiple of the MSCI World Index ex-US trades at a little over 13 times earnings, where the average stock in the US or the US index trades at about 20 times. Now, the average stock doesn't always mean so much, because if you take, the big tech stocks, they trade at an average of 30 times earnings. If you take the rest of the market in the US, it's about 18 times earnings, but it's still a significant premium people have paid because the US market was previously outperforming. When we look at the spread between global stocks and US stocks, we think global stocks are really inexpensive. And while there's some wonderful, great, big US technology companies, there's a lot of great industrials and financials and materials companies outside of the US, including Canada. China continues to see flows out, and it has been ugly. Today, we got a king-sized bounce up about 5.8%. We've been avoiding China, and we will continue to avoid China until we see there is some material shift in what's happening here. This was stimulated by some policy changes overnight. And frankly, they are discouraging people from selling stocks and not just using words. This is a market right now we think is sort of uninvestable. The China A shares index is trading down, going all the way back to 2015, and it's down about 60%. When we look at fixed income, we saw generational low in rates in 2020, much like we did at the end of the 1940s. And every indication is that we have shifted from a long-term downtrend to a new long-term uptrend, putting it under a microscope. The lows in 2020, moving in a series of higher highs and higher lows, which continues. And there's really no sign that we should expect a major drop in US yields, bond yields. We may see short-term rates come down, and we may see long-term rates come down, but there's no sign of a major shift here. Bonds continue to be in a bear market. When we compare stocks versus bonds, since the bottom in rates in 2020, stocks relative to bonds have steadily been moving from the lower left to the upper right. They are outperforming, including the bear market that we went through 2022 into 2023. Stocks we would prefer to own over bonds. When we look at commodities, commodities made their low in 2020 and have been working their way higher, certainly held back during the Fed's tightening cycle, but this is an upward price trend, higher highs and higher lows, and it's an asset class that's under-owned. Now, clearly, during the Fed's tightening cycle, those who wanted to bet against the US economy or the global economy, went out and often were shorting commodities, thinking that this is something that should go down a bunch if rates are high. Well, I can't see any indication that that's the case. All of the moving averages are working their way higher, and the broad-based commodities index is trading above those levels. So when we see the Fed start to cut rates, this group should start to take off. Two things are important for commodities. One, US dollar, and US dollar rallied a little over the last couple of months, and yields. If yields start to back off a little and the US dollar starts to back off a little, as we saw it do today, it's likely to see, good strength. Today, with the US dollar backing off just a small amount, the global stocks like Brazil was up 2.7, materials were up, the energy sector was up. Things that are sensitive to the US dollar had a very good day. Copper index up 1.6%. So these are things that we watch for. Now, as I mentioned earlier, we don't have to be everywhere. And everybody has a different approach to things. At Barometer, our focus is trying to identify the key areas of the market that are benefiting from a structural change in the backdrop. Things that are good to begin with, but where we can see something is changing for the better, and investors may be prepared to pay a higher multiple or valuation as time goes by. It could be specific geographic regions, as we just talked about. It could be specific asset classes, say equities versus bonds or commodities. And it could be specific industry groups or themes within the market that we want to focus on. We're always watching for change. One of the reasons we do this webcast every week is it's a discipline to have to look across the market to say what's changing, and then does our portfolio make sense given what we think we know. Since March of last year, we've seen broadening in the market. We've seen a broad base of equities and commodities do better. It's been very clear opportunities, and we're seeing the portfolios react. The 9 months to the end of the year was a very strong 9 months, and frankly, the first month of the year has also had good results. If our breadth work and our risk work starts to show weakness, then our job is to play some defense. Not really the case right now. The investment strategy has been generally very clear. We think that the big issues that impact your return are our ability to get to the right asset classes and the right sectors within those groups. 70% of return at least. 30% of return is finding securities to express that view. So our top-down work tries to identify the right neighborhoods for us to focus in. We talk about those on this webcast. And then our bottom-up research is aimed at finding specific securities within the sectors or themes that we're focusing on that not only are good to begin with, but are showing some sign of positive change, and where price is behaving well relative to the rest of their peers. The research team goes through this process daily to reevaluate every position every day. The top-down work is based on trying to identify parts of the market where over time more and more securities are participating in strength. That's a sign that there is broad-based buying across that universe. As long as the percent of stocks in uptrends is rising, that means it's a broadening, healthy market. It's hard to lose money. When breadth starts to contract, it may not be obvious in the leading stocks, but generally it's the weakest stocks that roll over first. So if you took an industry, the strongest stocks often carry on while the weaklings start to lose their gains. We track this across about 300 universes of securities. When we see deterioration in breadth, it doesn't mean we're going to go sell everything, but it means we have to be a little more vigilant. It means we don't put any new positions on in this neighborhood. And to the extent we get stopped out or new money comes in, we keep that cash on the sidelines. So we're always looking for expanding breadth. So where do we sit? As we sit today, over the course of the last month, the percent of stocks in the US in uptrends has backed off by about 8%. So what does that mean? About 60% of stocks are performing really well. There's about 40% that are not eligible for us to hold in portfolios. The percent of stocks trading above their 50-week moving average has come down from about 86% to about 45%. So as we talked about, the market's been working off this overbought condition. And we haven't been doing a lot of buying. The percent of stocks trading with positive weekly price momentum came down from about 90% to about 20%, but has started to rise again. That's an indication that we've worked through this overbought condition. And the percent of stocks trading above their 150-day moving average backed off by about 10%. Now, that's looking at the broad-based US markets. Globally, bullish percent or percent of stocks in uptrends has continued to rise. And in Canada, it hasn't moved lower. It's been very resilient. When we look at Asia Pacific area in particular, which includes Japan and India and a bunch of other markets, we can see that about 48% of stocks are in uptrends, and that hasn't backed off any over the course of the last month. In fact, it's continued to strengthen. Now, this can get up as high as 70 or 80% and then stay there for a long time. We know we've had many years where we've been in a range, but the percent of stocks in uptrends is improving, which means we want to be looking at global stocks. When we look at the Nasdaq, there's some great looking stocks in the Nasdaq, and we're fortunate we've got a handful of the most important. But I will say that at the end of December, 88% of all of the companies in the Nasdaq 100 were on uptrends. It backed off a little in January, rallied in the middle of January to a lower high, meaning fewer stocks were in uptrends. And as we sit today, about 70% of stocks are in uptrends. So the market in the Nasdaq is doing some sorting. The strong are getting stronger, but there's some in there that are waning, and we're watching those closely. Now, we're in the middle of earnings season. As you can see from this chart, about 220 companies as of this morning had reported. The average company is beating the revenue estimates by about 1%. Sorry, go back. And the average company is beating the earnings estimate by about 7%. So companies are beating the estimates. In particular, it's interesting. The average energy company has been beating the earnings estimate by about 13%. When we go down to consumer discretionary, they're beating by about 13%. But broadly across the board, estimates have been too low. We'll see what happens coming out of this reporting season. On the employment front over the last week, we saw an uptick in new jobs. So we continue to see increased hiring, showing that the US economy continues to be strong and is not showing any sign of weakness. From an inflation perspective, when we look at core services and goods and services ex housing, we're seeing inflation come down across the board. And in fact, core goods has moved negative. That's a positive. It gets us closer to the point where Powell looks at cutting rates. Many of you may have seen Powell's interview on 60 Minutes on Sunday night. You know, he's trying to tell us, well, it's not yet, it may not be March, but you should expect the next move to be a rate cut. That ultimately is a positive thing. And frankly, we still have a very strong economy in the face of all those rate hikes. Let's talk about leadership for a second. Technology continues to be very strong. This is relative strength of technology versus the rest of the market. After a horrible year in 2022, 23 started out right from January as a stronger move, and it's led all the way along. It's trading now, the XLK, which is the large cap growth stocks, trading better than 89% of companies in the S&P. We've been backing and filling a little bit over the last 2 weeks, but in general, we've seen some very good numbers. In particular, over the past week, Meta Platforms, Facebook, had just a dynamite result. Stock was up 20% the day that it reported. This is one of our top 10 positions. One we talked about last week, frankly. I'm very happy to see that. Amazon also absolutely killed the numbers, came in well ahead on good expense management, big pickup in relative strength over the course of the week. So there was some really nice moves. Financials continue to look really strong. Nice, steady pickup in relative strength versus the rest of the market. This is the broad-based financials ETF XLF. It includes insurance companies, includes banks. It even includes regional banks, which are having a tougher time. And it includes financial technology companies. Our focus is largely in insurance companies. We do have some bank exposure. We have no regional bank exposure. In fact, in our macro portfolio, we are short the regional banks. That's where we think there may be some real estate problems. When we look at the percent of stocks in uptrends, nearly 100% of financial services companies are in uptrends. And this has been rising steadily all the way through since June of 2023. The sector broke above resistance recently. And we talked about the fact that we think it looks like it's in a new bull market. This is the XLF going back to 2008. A lot like global stocks. Well, frankly, it's because financials make up the biggest part of of global markets, about 24% of the MSCI ex-US index. Again, like other markets, 4 sharply higher months in a row. Industrials. Industrials are now trading about 10% above the highs achieved at the end of 2022 before the bear market. This group has shown leadership all the way through the rally from last summer, and relative to the S&P, it's just made a new relative high. So leadership should have persistent excess returns above the index. Now, the industrial sector is not a huge sector, nothing like the 30% that makes up technology. But we like to see when the equally weighted index, meaning every stock gets a single vote, trades at new highs, and on a relative basis is making new relative highs versus the S&P. This has been an important group for us. Now, last week we talked about the fact that earnings growth bottomed at the end of 2022 and has been improving since, and we think likely will be 15% earnings growth by the end of 2024. This is a chart from JP Morgan I thought was interesting. It plots global manufacturing PMIs, Purchasing Managers Index, bottoming at the end of 2022. And of course, going through a bottoming process, but clearly turning higher here, back through the 50 line, which frankly means manufacturing continues to expand. In this group, one of our big positions, a top 10 firm position, is Eaton Corp. We talked about it last week. Reported their earnings. Again, look at this move. A lot of these companies beating estimates, not just based on sales, but on expanded profit margins. And certainly we like to see that. Howmet had a great week, which is in the defense space. They still are 7 days away from reporting, but certainly the telegraphing is good. We're making new relative strength highs versus the market. So this is the third biggest sector weight for us behind financials, technology. Next came industrials. And BWX we talked about, they're in the business of maintaining and building small modular nuclear reactors. We think this is going to be an interesting area that's being commercialized currently. Last few groups, materials. Materials had pulled back a little bit over the last few weeks. Certainly that's been on a stronger US dollar. We're watching it closely. Uranium as a group certainly hasn't shown any weakness. Very nice relative strength improvement. Pulled back a little over the last 3 days just because we gapped higher. We came and filled that gap. Cameco's been a strong leader in the group. Next Gen Energy has been a very good place to be. The aggregates and cement companies benefiting from the spending on infrastructure, nice rising relative strength, made new highs over the last week, and the metals and miners look like they're turning back higher after consolidating over the course of 4 weeks. So no major changes in these big structural themes. When we look at energy, energy looks like it's trying to make a turn higher here. We'll see. Oil has support down around $70. I think we closed today at $73.50. So that continues to look okay. In the drugs, Lilly reported their earnings this week. This is a top 5 position in the firm. Boy, oh boy, are these GLP-1 drugs doing well. Their GLP-1 drug, which we all think of as weight loss drugs, really has only been approved for diabetes. Revenue in that drug has gone from 200 million to 2 billion, up 10 times, without yet being approved for weight loss. So this one we think is an important drug. Certainly the market liked the earnings result, trading better than 96% of companies in the S&P over the last 12 months. In the consumer, we get Uber's earnings tomorrow. It's been a great week. It had a sharply higher day today, made a new relative strength high, and Loblaws has really been powering higher since October as the grocers are continuing to do well. So our focus in this area has been grocery. When there's inflation, revenues go up more quickly and profits tend to go up more quickly. So Couche-Tard, Dollarama, Loblaws, all performing quite well. So now we look at the groups that haven't been performing to see if it's changing. Utilities made a relative strength new low yesterday. So the XLU ETF trading only better than 26% of the companies in the S&P, and relative strength continues to fall. No check mark here. Real estate investment trusts. They had a little bounce through October and November, but making new relative lows versus the market. So to sum it up, financials, industrials, and technology companies have a high percentage of stocks in uptrends. And over the last month have moved higher than where they were a month ago. Percent of stocks in uptrends in financials a month ago was just below 80%, now basically around 100. Industrials are the same, technology is the same, materials, they're the same. When we go to the other end of the spectrum, staples and utilities are the two weaklings. So we got to pick our spots. A couple of key data points. When we compare the transports ETF versus utilities, we think of this as offense versus defense. Offense started to work when rates bottomed in 2020. We went through a bear market, but since September of 2022, making a series of higher lows and higher highs, and transports relative to utilities are now just making another new all-time high. That tells us that investors are working on offense, not so much playing defense, which is what you would expect if you thought there was a recession. We talked before about the theme where we went from 40 years of the borrower being in control to probably what will be 30 years of the lender being in control. So we compare financials, lenders, relative to real estate investment trusts. Real estate investors tend to be borrowers. The bottom in this relative trend was when the rates bottomed in 2020. And clearly, the lenders are winning. So financials make a lot of sense. Obviously, they're lenders. So when we sum it all up and look at our current holdings, financials make up about 25% of firm assets. To be clear, this is not all banks. It's largely insurance companies, asset managers, fintech, and we do have a small short position in our macro portfolio in regional banks. Technology is a significant weight, although it's an underweight given the fact that the valuations are high and there's other things in the market to do. Technology tends to be a pretty crowded sector, and they're going to have to continue to report great numbers, which they're doing. Margins in general were up sharply on the quarter, and of course, revenues in many of the companies beat. Industrials is a significant overweight versus market. Energy is about an equal weight. On my camera, materials about an equal, about 3 times market weight. Energy is a small overweight. Consumer staples an underweight. Healthcare an underweight. And when we go to the other end of the spectrum, utilities and real estate really non-existent. So the very defensive sectors, government bonds, almost non-existent. Cash largely put to work. Communication services, real estate, and utilities. These are areas we think we can avoid. They're low relative strength parts of the market. They were broadly overowned by people who thought we were headed into a deep recession, and they just haven't worked. We think they're going to be sold over the next number of months. And we think that there are new bull markets in the areas here at the top. So looking forward, we're in the time of year when we tend to have positive flows into the market. Credit spreads, or the excess return of bond investors expecting to take the risk to buy a corporate bond, that spread has been falling, meaning that bond investors are getting increasingly comfortable that there's no big credit calamity on the horizon. Volatility, VIX, which options traders use to price options based on the amount of volatility they're expecting in the market, is trading at a low level and at a level that is commensurate with bull market activity. So we think we're in the next bull market, and there's lots of things for us to worry about, and we watch them every day. Should things in our portfolio start to change, we can always get defensive. We use stops on all of our positions. Stops are useful for two reasons. A stop loss is put in below the price maybe we've paid, and then ratcheted higher as a position works out as we hope or expect. The obvious reason you use a stop loss is so you don't let a little mistake turn into a big one. It's like a circuit breaker that stops you from rationalizing holding an underperforming position. But the second reason we like to use stop losses is that we don't like to try to pick tops. When something starts to work, like Lilly has over the last year, or Nvidia, you never know how far it's going to go, and often things can go a lot further than you expected. If you use a stop loss to make your exit, it means you can hold your winning positions as long as they continue to work. Now, we've just made a new high. We know that when we make new highs after over a year, it tends to be that stocks run for a longer period of time. So we've all lived through some ups and downs over the last couple of years, but we're in a better environment, and you can see some consistency in the portfolios where there's not a lot of change. So we'll continue to monitor for things that could go wrong. We'll monitor all the individual positions. We'll look for new signs of leadership or old leadership starting to recede. But in the meantime, we want to remember these statistics. When the market goes a while without making a new all-time high over a year, 1 month out, you can get some retrenchment. And we got new highs in January. So it's possible we could pull back a few percent. We think that our themes look very stable. 3 months out, going back to 1950, the market was up 92% of the time. 6 months out, market was up, a high percentage of the time, and 1 year out, virtually 100%, 92% of the time, market was up on average about 12%. So I think we've got a pretty good backdrop. We think we've got some pretty good leadership themes. Not seeing a lot of things to be overly concerned about. We are always watching. And with that, Pamela, if there's any questions, certainly we can try and answer them.
Yeah, thanks so much, Dave. We do have some great questions here today. Your question box is full. Sebastian starts with, David, any thoughts on EEM and the rails?
Sure. Okay, great question. So let me see. Just share my screen here. Let's jump. So on the rails are acting really well. So if we pull them up one by one, this is CSX, trading better than 82% of companies in the S&P. If you pulled up Union Pacific, it's had a really nice move here, trading better than 81% of companies in the S&P. Here in Canada, we look at CP, which is a holding. We bought this recently, and I think we actually bought some more today. You're just trading through all of this resistance. So at $85, this looks pretty interesting. I love to see stocks trade sideways in a range for an extended period of time and then ultimately make a new high. Just, as it did going back in 2019. So we think the group looks pretty good. We looked at transports versus utilities. In general, they're behaving pretty well. If we look at the transports as a whole, we've just taken out some resistance. I think the group looks pretty good, and I think Warren Buffett's probably pretty happy with his buy of Burlington Northern. Was there another part of the question, Pamela?
No, I think you addressed that one pretty well. Thanks, Dave. The next one comes from Paul. Paul asks, breadths seem to be widening through January, but has that seemed to have slowed this past few days as big tech has moved up again? What does your data say, David?
Yeah, no major changes. Frankly, as we said earlier, like Nasdaq 100 breadth has come down by about 10%. So 10% of stocks in the Nasdaq 100 are given sell signals, but there's some really strong names there. It's a pretty broadly held group, and we're really happy. Like our analyst, James Callahan's done a great job leading into earnings to build the right expectations. On the year, the equal weight S&P is about flat. So it hasn't made a lot of progress. Large caps have been a little bit better off the bat. S&P is up by a couple of percent. We're really happy. Like our equity fund is up a little over 6% so far in the year. Income fund is up about 4%. So there's lots of stuff that's working. But it continues to be a pretty focused market. We'll see whether the defensive sectors can join the rally. At this point, I'd rather be targeted in those sectors that we're talking about.
Thanks so much, David. The next question comes from Alejandro. Alejandro asks, good afternoon, David. On your view of a reflationary cycle that we are in, where interest rates will stay higher and also construction and manufacturing will be stronger, which sector do you see would have a higher upside for 2024? Financials, which include, and he puts in brackets, banks, insurance companies, industrials, or commodities or material companies. What do you think about that, David?
Look, here's the hard part, and I always think about this when I go to do BNN Bloomberg and they want to talk about three stocks. You never know exactly where the leadership is going to be, but you can find the right neighborhoods, right? So I think that if you can have a portfolio that owns some industrial exposure, large cap industrials, if you can have some large cap resource producers that are cash flow generators, not speculative positions, but cash flow generators and dividend payers, and a good financials portfolio, that strikes right in the heart of reflation. Now, to be clear, financials underperformed, for 15 years. And as a result, they're a very much smaller part of most people's portfolios. Same with commodities. They're underowned. Industrials in general also underowned. So there's very clear leadership in those groups. I think that day by day, it's going to drag investors in, because it's not just 7 stocks doing well in the market. There's some great opportunities and really nice, response to earnings reports in these groups. So try not to just be too focused, pick a handful and make sure you got exposure to those 3 groups.
David, another question here. It's more stock specific, wondering what happened to Rambus today.
Yeah, Rambus did not have a good day. The market did not like its earnings report. Now, it has a history. It's a very volatile stock. So it has a history of having big responses right after earnings. It's one of those companies that you kind of have to give it a few days. But if you go back and look at other earnings reports, there have been several where you got a negative response and then a stabilization over the next couple of days. We had a very small position, and likely that will wind up being gone for us.
Thanks so much, Dave. Last question of the day comes from Paul. He says, due to mortgages being fixed for the full term in the USA, the impact on the consumer has been delayed. Recently, bankruptcies are up and car sales have slowed significantly. Is this a sign the soft landing is at risk? What are your thoughts there, David?
Yeah, so remember, the consumer is 70% of the U.S. economy, so you have to consider that. If we take the big premise that we move from a world where the borrower was in control to a world where the lender is in control, you probably don't want to be focusing on weak balance sheets. So, you could see that in our portfolios, we have a pretty underweight position in consumer companies. And the companies that we have are companies that are sort of bulge bracket companies that are taking market share, Uber, Amazon. And then in the low end consumer, we're focused on Dollarama and Couche-Tard and Loblaws here in Canada for grocery. We're not focused really on the luxury consumer right now. And I do think you got to be a little more cautious. There are a lot of leveraged people out there. And frankly, there's probably more leveraged people in Canada than there is in the US. So you have to kind of pick your spots, I think.
Thanks, David. Well, that concludes the questions we've received this afternoon. So as always, I leave you with the final word. Thanks so much.
Yeah, look, I know we're all trying to look around corners and find where the next disaster is. We've seen enough of them. I think we all got to watch the jobs data. The jobs data continues to be remarkably strong. Immigration is helping from an inflation perspective because it is increasing the job seeking universe of people. I think that we also have to be open to the fact that, reflation, when it starts, floats a lot of boats. And there are the sectors that are tied to reflation are generally underowned and very inexpensive relative to history. So we got to keep looking forward and keep making sure we're positioned for what's coming at us, not looking backwards. And I think one of the simplest ways of looking at things, the market's making higher highs and higher lows, and we're taking out old highs, that's bullish. And a lot of people are slowly going to have to change their views. So with that, we'll hang it up. I appreciate everybody tuning in. Hopefully these calls are useful. If you got stuff that you'd like us to talk about, please send us a message. We had 7 or 8 folks reach out in the last week, wanted to have conversations, and we're always happy to talk to people about their portfolios and answer their questions if they're too shy to ask on the webcast. But thanks for tuning in and being engaged, and we look forward to seeing you again next week. Thanks, Pamela, for hosting.
Thanks, David. Have a
Bye,
great
folks.
evening.